Can you legally pay $0 in federal income tax? For millions of Americans, the answer is yes, and it doesn't require loopholes, offshore accounts, or creative accounting. It requires understanding how deductions, credits, and exemptions actually work. We're going to walk through 5 real scenarios, with real math, to show exactly who qualifies and how. Scenario 1. A married couple with 2 children earning a combined $70,000. They take the standard deduction of $32,200, bringing their taxable income down to roughly $37,800. Federal tax on that amount is approximately $4,200. But they have 2 children, each qualifying for the child tax credit of $2,000, that's $4,000 total. They also qualify for the new OBBB Universal Savings Credit and other adjustments. After credits, their federal tax liability drops to near zero. The key here is that credits reduce your tax dollar for dollar, not just your taxable income. A family of 4 at $70,000 can absolutely hit zero. Scenario 2. A single person with no children earning $45,000. Standard deduction, $16,100. Taxable income, about $28,900. Federal tax, approximately $3,200. Without children, there's no child tax credit. But this taxpayer maximizes their 401k contribution at the workplace, $23,500, which is pre-tax. That drops their adjusted gross income to $21,500, and after the standard deduction, their taxable income is approximately $5,400, resulting in a tax bill of about $540. Add in the saver's credit for retirement contributions, and the bill drops further. It's harder to hit exactly zero without dependents, but with aggressive retirement savings, you get very close. Scenario 3. A retired married couple, both 65 or older, with $50,000 in Social Security and no other income. First, only a portion of Social Security is taxable. With no other income sources, they may only have about $10,000 to $15,000 in taxable Social Security. Now stack their deductions, standard deduction of $32,200, plus the age-based additions of roughly $3,200, plus the new OBBB senior deduction of $8,000. Total deductions, over $43,000. Their taxable income after deductions, zero. This couple pays absolutely nothing in federal income tax. And this is the reality for millions of retired couples across America. Scenario 4. A restaurant server earning $25,000 in base wages and $30,000 in tips, $55,000 total. Under the new no tax on tips provision in the One Big Beautiful Bill, tip income is exempt from federal income tax. That means only the $25,000 in base wages is subject to tax. Standard deduction of $16,100 brings taxable income down to approximately $8,900. Federal tax on that, roughly $920. With the Earned Income Tax Credit and other available credits, this server could reduce their federal tax liability to zero, or even receive a refund. The tip exemption is the game changer here. Scenario 5. A self-employed freelancer with $60,000 in net business income. First, they deduct the employer equivalent portion of self-employment tax, roughly $4,200. Then the qualified business income deduction, 20% of qualified income, reduces taxable income by another $11,000. That brings adjusted gross income to about $44,800. Standard deduction of $16,100 brings taxable income to around $28,700. Tax owed, roughly $3,200. Hitting zero is harder here, but adding a solo 401k contribution of $20,000 drops taxable income to approximately $8,700, tax of about $870. With health insurance deductions and the saver's credit, the freelancer can get very close to zero. Self-employment requires more planning, but the tools are powerful. Let's be honest. Not every scenario reaches exactly zero. The single filer without dependents and the freelancer both have remaining tax liability even after aggressive planning. But here's what matters: every single scenario shows a dramatic reduction from what most people assume they owe. The family of 4, 0. The retired couple, 0. The tipped worker, 0. And the other two, hundreds instead of thousands. The tax code rewards people who understand how it works. Most people overpay because they don't know what's available to them. Here's your action plan. First, identify which scenario is closest to your situation. Second, calculate your deductions, standard versus itemized. Third, list every credit you qualify for: child tax credit, earned income credit, saver's credit, education credits. Fourth, maximize pre-tax contributions: 401k, IRA, HSA. Fifth, if you're self-employed, set up a solo 401k before year-end. And sixth, run the numbers before April 15th, not after. The difference between paying thousands and paying zero is often just knowing the rules.
Money Unwrapped. See you next time.